If inflation is 4%, but a treasury yield, a 10-year treasury yield gives you 7%, well then you have a 3% positive real yield. And so the opportunity cost of holding a yieldless asset like gold is pretty high, and therefore it's somewhat less attractive. That's basically a strong currency dynamic. Even during the inflationary 1970s, the two spikes where gold did particularly well was when real yields hit their bottoms, and then the periods where gold corrected was also because real yields were rising somewhat. They were becoming less negative. If inflation's only 2%, but your yield is 1% on your treasury, well then you're getting a negative 1% real yield in your treasury. And so even though inflation is not super high, that's a really unattractive. It's unattractive to hold cash. It's unattractive to hold treasuries, where something that scarce yieldless asset looks a lot better. And so that basically, if you look at 50 years of data, gold has quite a strong correlation in rate of change terms with real yields.
So, if you have, say like you're in the 80s, right? So inflation was, pretty high in the 80s, but gold still did very poorly because one, it did very well, in 1980 itself, like at the end of the 70s. So it was in that kind of bear market. And two, because even though inflation was still kind of hot in the 80s, yields were above inflation. And so you got a positive real yield on your treasuries. If inflation is 4%, but a treasury yield, a 10-year treasury yield gives you 7%, well then you have a 3% positive real yield. And so the opportunity cost of holding a yieldless asset like gold is pretty high, and therefore it's somewhat less attractive. That's basically a strong currency dynamic. If inflation's only 2%, but your yield is 1% on your treasury, well then you're getting a negative 1% real yield in your treasury. And so even though inflation is not super high, that's a really unattractive. It's unattractive to hold cash. It's unattractive to hold treasuries, where something that scarce yieldless asset looks a lot better. And so that basically, if you look at 50 years of data, gold has quite a strong correlation in rate of change terms with real yield. And so what we saw from 2018 to 2020 was that real yields based on the 10-year treasury minus the tips market break-even rates for inflation. That's what the gold market follows kind of in real time. And so we saw that fall from 1% to negative 1%, and it bottomed around August 2020. And that even though inflation was kind of heating back up a little bit, nominal yields actually rose faster than break-evens. And so you started to get a rising real yield, even though it was from a very low base. It was still negative. It was just less negative than before. So combined with the fact that gold did very well recently, that there's a lot of euphoria around it, gold started entering a correction for several months. Even during the inflationary 1970s, the two spikes where gold did particularly well was when real yields hit their bottoms, and then the periods where gold corrected was also because real yields were rising somewhat. They were becoming less negative. If we start to get basically a policy mix that focuses more on fiscal stimulus than on monetary stimulus, if you kind of focus on potentially moderately higher inflation levels during the 2020s, while rates are still held low and therefore real rates are somewhat negative for a lengthy period of time. If you start to see rebounding in China and India in terms of commodity demand, that all represents a pretty attractive mix for commodities as you look out into the 2020s decade. There are periods of time where commodities are scarce, the prices are good. Companies pour money into finding new deposits of things. They spend all that money to get that out of the ground. Then they oversupply the market, or there's some sort of demand destruction, like we know in the 2000s, for example. We had a very strong commodity market, but then eventually China slowed down, right? So we some of those projections for commodity demand flattened, and so then in the 2010s we entered a period of commodity oversupply, especially in the oil markets, and so that basically gave us a structural bear market for commodities that lasted quite a while. But as you look out in the 2020s, there's not, oil capex is way lower than it was years ago. Copper is interesting because despite having, a decent amount of capex, they're not finding giant new deposits in the same way that they were. And so that's a pretty tight market the longer you look out. A number of other commodities are kind of in a similar area. And then, if you throw in some ESG things, like there's not a lot of, interest in investing in oil companies, for example. from pension funds, and so those were some of the original entities that sourced, for example, unprofitable shale oil. And so a lot of those companies never made free cash flow, but they had persistent demand for their equities, for their debt, that they could, kind of keep running. But now, if there's less external demand from large pools of capital, then those companies are forced to be more, free cash flow positive. Yeah. So ever since the early 1970s, we've entered this free floating exchange rate, around the world, where the dollar and other currencies float against each other. And during that 50-year period, we've had, three big bull markets in the dollar. We've had like, 2.5 bear markets, where the previous two times it ended in a big bear market. This time we've been in kind of an early stage of a bear market. It's still unclear how this latest cycle is going to play out. And, because the dollar is the global reserve currency, we have kind of certain dynamics with it. And so in the 70s, they made deals with Saudi Arabia and other oil producing countries to only sell their oil in dollars. And so we basically made a structure where the whole world needs dollars. So even if you're France, if you want to buy oil from Saudi Arabia, you need dollars to do it. And so we have this, this global demand for dollars that's called structural U.S. trade deficits. And so it's kind of propped up the purchasing power, of the currency, but it's kind of, decreased our export competitiveness. And then you get these big kind of rotations in the dollar compared to other currencies based on shifting fiscal and monetary policy mix. And so, in the 1980s, we had a really big dollar spike, and then because the dollar is the global reserve currency, it's the global funding currency. So a lot of emerging markets, when they borrow, they basically, they issue bonds or borrow from banks. It's often in dollars, and so if the dollar strengthens a lot relative to the local currencies, that causes issues. And so whenever we have these dollar spikes, we have a global slowdown and usually an emerging market crisis, and then that kind of, eventually weighs on U.S. GDP growth as well. Now, what we've seen over the past, month or so is that, long duration treasuries have kind of flattened out somewhat. They've come back down a little bit, while inflation now is starting to heat up more, and so real yields have, gone back down to some extent. They're still not quite as low as they were back in August 2020, but they are, headed in that direction. While we've also seen somewhat of a bounce in gold, so that inverse correlation is continuing. And the interesting thing is, as you look at these base effects, if we do get some interesting, headline CPI numbers, especially if they overshoot expectations, that could be a decent environment for gold, because it's unlikely that treasury yields are going to be able to keep up with those CPI changes from these base effects. So this is something I'm watching. I'm still long-term bullish on gold here, but basically the timing of that's going to follow what happens with real rates. Gold has quite a strong correlation in rate of change terms with real yield. Real yields were rising somewhat. They were becoming less negative. In the 2010s, we entered a period of commodity oversupply, especially in the oil markets.